Welcome to the deep dive. Today, we're plunging into, the pretty complex world of personal finance. Specifically, we want to understand how financial advisors really get to grips with your needs, what makes you tick financially. Our mission here is to basically pull out the key insights from our source material, give you a shortcut, really, to understanding how your financial needs change over time and how the pros try to help you navigate that.
Yeah, and it's so much more than just picking products, isn't it? Financial advice really, it's about understanding people, their specific lives, their hopes. It changes all the time. And it absolutely relies on trust, building that trust first, and then finding solutions that aren't just okay, but are genuinely tailored to the individual.
That sounds like a massive challenge, though. If our needs are always shifting, how does an advisor, ever really understand the full picture? One thing that jumped out from the sources, kind of a visual way to think about it, is this financial life cycle.
Oh, absolutely crucial, yeah. This life cycle idea, it maps things out. From being a student, maybe 16, thinking about saving for, I don't know, a gap year,
Hmm.
right through to retirement, 60 plus.
Yeah.
It's the framework. It really shows how financial needs aren't static at all. They change dynamically over your lifetime,
Uh-huh.
often in ways you can sort of predict. But, what's really interesting isn't just that they change, but how hard it can be for people to see those changes coming
Yeah.
or to break out of old habits from an earlier state.
Inertia, right, getting stuck.
Exactly. The real trick is understanding that inertia and helping people move forward as their lives evolve.
Yeah, and the examples really bring it home. You take students, 16 to 20, simple stuff maybe, saving for holiday, funding college. Then boom, young adults, 20 to 30. Suddenly it's like thinking about mortgages, pension provision, big jump.
Huge jump.
Then young families, 30 to 40, childcare costs shoot up. And suddenly, income protection, life insurance, that becomes really vital. It changes so fast, doesn't it?
It really does. And then you get to, say, mature households, 50 to 60, often peak earning years.
Right.
So the focus really pivots. Maximizing pensions, serious retirement planning.
And then retirement itself, 60 plus, different ballgame again. Turning savings into income, managing what you have, thinking about long-term care.
Yep. And alongside all that, our attitude to risk changes too. And how quickly we want to access our money, liquidity. Those sorts talk about a typical savings pattern. You start with cash, easy access stuff, current accounts,
Makes sense.
then maybe fixed-term bonds, bit better return, less flexibility. And then maybe if you've got the buffer in a longer time frame, you look at equity-based things, unit trusts perhaps, accepting more risk for potentially more growth down the line. It kind of mirrors our life stages, how comfortable we are with risk.
Okay, so if needs change that much and people have this inertia,
Yeah.
how do advisors actually figure you out, beyond the bank balance at any specific point in that cycle?
Right. Well, that's the job of the fact find. It's a systematic process. And it's heavily regulated, actually. The whole point is to gather all the relevant info. Your circumstances, your experience, your needs, your goals. Advisors legally have to take reasonable steps to make sure their advice fits you. It's not optional. It's fundamental.
And the level of detail they go into for the hard facts,
Yeah.
it's pretty intense.
Oh, yeah.
Your date of birth, obviously, but that's crucial for underwriting, you said? Assessing risk.
Exactly. Underwriting, assessing the risk for things like insurance. Age is a big factor.
And relationship status. Single, married, divorced, that hugely impacts planning, right?
Massively. Dependents, beneficiaries, kids. It all feeds into planning for things like, well, death, disability, saving for school fees.
And your whole financial setup, job, income, benefits, even past jobs.
Yep. And a really detailed income and expenditure breakdown. What's coming in, what's going out, what's left over or not.
Wow. And assets, too. What you own, property, savings, pensions. Is it yours? Jointly owned? What's it for? Value return, tax.
Every detail matters. The tax status, any penalties for getting the money out, who it's held with.
And liabilities on the other side. Mortgages, loans. Who you owe, how much. The terms, interest rates.
It's about building that complete financial blueprint, like you said, not just a checklist.
Okay, that covers the numbers, the hard facts. But surely it's not just about the figures. What about the person behind them?
Absolutely not. That's where, well, honestly, it gets really interesting. The fact find isn't just about hard facts. It's just as much about soft facts.
Soft facts.
Yeah, your feelings, your hopes, your opinions. The advisor needs to ask questions that dig into that. How do you actually feel about how your money is set up right now? What are your goals, not just for retirement, but next year, 5 years? Are you actually willing to do something? Is your situation likely to change soon? What really motivates you? It's the human side, the
Yeah.
why.
So they're asking things like, what are your retirement dreams? Or how do you feel about how your investments are doing? Maybe what are you saving for? Any plans to gift money? Things like that.
Exactly those kinds of questions. But your point earlier is good. How well do people actually know or share this stuff?
Yeah. Do people sometimes say one thing, but their actions or the hard facts suggest something else?
Oh, definitely. Happens all the time. Someone might say they're a risk taker, but all their money's in cash. Or they say they want to save aggressively, but their spending says otherwise.
So how do you bridge that gap?
That's where establishing attitudes and preferences comes in. It's about digging deeper than just what someone says. Really understanding their genuine attitude to risk. Are they really cautious or truly adventurous? And crucially, their capacity for loss. That's, can they actually afford to lose money without it causing real problems? It's a practical thing.
Right. Not just how they feel, but what they can handle.
Exactly. And sometimes advisors use tools like psychometric testing
Psychometric texting.
for finance. Yes, structured questions or scenarios. They're designed to get a more objective measure of your true comfort with risk. Sometimes it tells you things you didn't even realize about yourself. Helps match the soft intent with the hard reality.
That sounds incredibly thorough. Makes you think about alternatives like robo-advice, lower cost, remote.
Mm-hmm. And those hybrid models, too, mixing tech and humans, is their fact find as deep or just different?
Well, for simpler needs, robo-advice can be very efficient. The fact find is automated, very structured. Hybrid tries to blend it, tech for the data crunching maybe. Humans for the deeper soft fact stuff. The goal's the same, though. Get enough good information to get suitable advice.
Okay. So once all that info is gathered,
Yeah.
what next? How do they pinpoint the actual needs?
Right. So then the advisor identifies specific areas of financial need. The source material highlights 5 main ones. First, protecting your dependents if you die prematurely. Loss of income, basically. Second, protecting yourself or dependents if you lose income long term, maybe through illness or disability. Third, providing income in retirement so you can live comfortably. Fourth, growing or protecting the money you've already saved or invested. And fifth, saving tax, making things more tax efficient.
And you can immediately see those playing out, like the young family without enough life cover on their mortgage. That's need number 1, right?
Exactly. Or someone with loads of cash savings paying unnecessary tax. That's need number 5. They're real-world problems.
But what if someone has, like, 3 of those needs all at once? How do you decide what comes first?
Yes. The critical step. Agreeing order of priority. This is key because, and this is important, the client's priorities might not be the same as what the advisor thinks is most urgent, and that's okay.
That must lead to some interesting conversations.
It does. It has to be an open discussion. How do you make sure everyone's aligned when maybe the client wants the shiny new investment, but the advisor sees a gap in basic protection? Yeah, that's the tricky part, isn't it? The client wants the big holiday fund, but the advisor knows they need an emergency buffer first. How do you handle that without sounding like you're lecturing them?
It's about transparency, explaining the why, showing how foundational things like that emergency fund protect everything else. You use the hard facts to show the risks and the soft facts to understand their motivations. It's a dialogue, not a directive. Once you agree the priorities, then you move to recommending solutions. And the goal, like the sources say, is pretty clear. Put the right amount of money in the right form, in the right hands at the right time. Precision, alignment.
Okay, so the solution has to fit the need, but also the person's whole situation and comfort level.
Precisely. And that means considering everything. State benefits they might get, stuff they already have in place, can they afford it, the tax side, the risk level, the time scale they're looking at, and how flexible the solution is. And crucially, any recommendation has to come with explanations. Why this product? What are the benefits? What are the risks? A summary of the reasons. Total transparency.
Makes sense. So, okay, recommendation made. But getting the paperwork signed, that's not the end, is it? What about closing the deal and what comes after?
No, definitely not the end. More like the start of the next phase. Completing the sale, as it were, really depends on 2 things. How the client reacts to the proposal, genuinely, and whether they truly understand it. That's why handling objections is so important. It's not an argument. It's a chance to understand. If someone says, oh, that sounds expensive,
Yeah.
a good advisor doesn't just defend the price. They might say, okay, so when you say expensive, are you thinking about the upfront cost? Or maybe the long-term value? Trying to uncover the real concern. Is it cost? Or maybe they just don't fully see the benefit yet?
Right, digging deeper. And then there's the official stuff, the disclosures. You mentioned kids.
Yeah, key information documents, or kids for investments. They're standardized summaries. Really important. Plus, product brochures, cancellation rights. It's all about making sure the client is fully informed, has time to think. Consumer protection.
Okay, so the product is in place. What then? Just leave it.
Absolutely not. That leads straight into after-sales care, which is vital. For two reasons, really. One, to make sure the product still fits as life changes, because life always changes. And two, to keep the client informed and supported.
And the sources mentioned two types of this care, proactive and reactive. What's the difference there? Why do you need both?
Good question. It's about keeping the relationship alive and relevant. Proactive servicing, that's when the advisor reaches out. Maybe it's an annual review, maybe you had a pay rise, changed jobs, got married. They initiate contact to check if things need updating before there's an issue.
Okay, staying ahead of the curve.
Exactly. And reactive servicing is when the client contacts the advisor. Could be anything. Can we talk? My circumstances have changed unexpectedly. Maybe they missed a payment, or sadly, even making a claim, like a death claim.
Got it.
Both are crucial. And underpinning all of this is meticulous record keeping. You need that history for good advice, and regulators demand it too.
So looking back at everything we've covered, it really shows that sorting out your finances isn't just about picking a product off a shelf. It's a journey, deeply personal, always changing.
Absolutely. It underlines that good financial planning hinges on really getting under the skin of someone's life. Their evolving needs, the hard financial facts, sure, but also those softer things, their feelings, their attitude to risk. It's an ongoing partnership.
It really is. Which leaves me thinking, given how much things do change over a lifetime and how unique everyone's situation is, how often do you, listening now, actually stop and think about your own financial life cycle? And maybe, just maybe, what might be coming around the next corner?